what tips do you have for maximizing profit on an Iron Condor using PowerOptions calculator? Now, this is actually, I'm going to say, a twofold question, because on the search tool, it is very simple to put in the criteria you want with the probability you want in any spread search, including Iron Condors, butterflies, standard vertical spreads, the bull put and the bear call, and the debit spreads. Bull call debit, bear put debit. Let's just go into the search and take a look. We have defaults that we've created for you to use as a stepping stone. Here's our weekly Iron Condor search, and it is looking for just the next week out. That's one thing I'm going to address, Joe, in this discussion in just a few moments. But what I want to do is let's just take a look. On any search tool for any strategy, you'll see a very similar structure between the options criteria that are available, the stock technicals, and stock fundamentals as well. Now, one of the basic things that we always look for in the fundamentals when looking to an Iron Condor is to avoid positions, stocks that have earnings between now and expiration. I do the same thing with all of my credit spreads. And the reason why is that this is a neutral position. I don't want to take the chance of any surprises coming up and affecting that. Okay, so we're just going to avoid all stocks that have earnings between now and expiration. Let's go back. To maximize return, I can simply say, well, just put in the highest return you want, whether you want it to be 15%, 20%, or 30%. We see here there's nothing that offers a 30% return for next week out. Why? Number one, it's probably too close in the sense that 7 days away, it's unlikely to find a 30% return with this probability between calculation that we're looking for. And what is the probability between showing us? It's showing us the likelihood that the stock would stay between the short call and the short put strike price at expiration. So here on MongoDB, never even researched them before, it's at 163. Short option bid at 75, but it's the 152.5 strike. It's now about 10 points out of the money. Let's call it 11. With the 177.5 short call, it's about 14 points out of the money, above the stock price. So we have a 76.5% probability the stock would stay between the strike prices. Now you're asking me, what can I do to get a better return? Maximize return, I should say. Maximize profit. Okay, well, if you want a higher return, we have to do one of two things. We might have to lower this range out of the money. At the same time, lower the probability. But I can't advocate that. In fact, there's other probabilities here that we can look for. The probability the stock would remain above the short put strike, and the probability the stock would remain below the short call or the break even for the position as well, because the break even might be slightly higher than the short call strike and the short put strike because of the net credit that you take in. So the first thing we have to address, Joe, and you can do this on the side, is to say to yourself, what are your goals for the Iron Condor and what is likely? I don't mean likely. What I really mean is what is practical. So for example, we pull up this default search for spreads that are 1 week out in time. We don't see anything with a 30% return. We also don't see anything that has less than a 70% probability. If you were targeting a 30% return, 14 days out in time, then you'd have to lower the probability in order for that to occur. Okay, everything sort of goes hand in hand. But we're not talking necessarily about just maximizing the percentage return, are we? I think what you're kind of asking is, how can I be more profitable long term with Iron Condors, maximizing my overall profit on the positions? And to do that, what I think is likely is we might actually have to increase the probability. And even the probability above the short put strike and the short call strike. I might even go as high as 85%. Why? Well, I don't want to, and I'm probably not going 1 week out. I'm probably going 2 weeks out. Okay, so I'm going to push this out to 14 days. I'm going to push this out to 7 to 14. Let's call it 8 to 14 days. The reason why I'm saying this is you're going to see some information coming out soon about years of trading, practicing, and testing different variations of bull put spreads. You might have seen one of our webinars before during this process here. Well, this information that's coming out has shown consistently over time and in different markets that looking for credit spreads with an 85% probability or higher and a return of around 14 or 15%, just the standard vertical, performs better long-term than looking for something, or even short-term, in different markets, looking for something that only has a 70% return, but a 25 to 30% return. I'm sorry, 75% probability, but with a 25 to 30% return. We started off with about 15% returns for 7 days out with a 75% probability, but I'm moving all of that up, and I'm extending the time to still be 5% out of the money, but still look for at least probably a 9 or 11% return minimum. Okay, because oh, there we go. That was my fault. Technically, 2 Fridays away is 15 days out in time. It's got to be included in there, and there we go. Now, there's only 12 results that match that. But you see the returns are still where we'd want. 2 weeks out, we look for a 12 to 13% return on a standard spread. With the extra credit, we're looking at 17, 19, and 22 because we're combining both sides. Now, I feel that this is probably a way that you could be successful more long-term. Now, I'm not even sure if you were doing weeklies, Joe. And if you were going 30 days out in time, guess what? I'd keep the same probabilities. I'd put the expiration to the next standard expiration, let's say August, but I'd increase the return to maybe that 20% minimum, probably 15% minimum as well to find good positions. Okay, now, the proof is in the pudding, so to speak. And my testing has shown that the bullish side is more successful with this criteria. The bull put credit spreads perform better than using, let me rephrase that. Bull puts going 2 weeks out in time with the right probability perform better over different markets, 1 year period, 2 year period, 5 year period, and more. 2 months, 3 months performs better than using the same kind of stock criteria but going only 7 days out in time. And the reason why is naturally you get such a smaller credit going 5 days out if you opened a position on Monday for next Friday's expiration, that when one trade does go against you, and they will, there are trades that are going to hit close to the maximum loss because of an unexpected event. But if I only got 7 or 8 cents for a 5-day trade, that 2-point loss, 250 loss, or close to it, is likely going to wipe out 20 previous trades. Going 2 weeks out, I have more sort of a 7-to-1 or 8-to-1 risk-reward ratio, and even if I take a 40, 50, or 60% loss, I've probably only wiped out 4 or 5 previous trades. It just performs better in all the testing we've done. And to be honest with you, looking for those smaller strike differences of 1 strike or 50 cents to get the lower margin, I found that not to work over time. And the reason why, because if the stock does start to slip, you're below both strike prices very fast or above both strike prices on the call side very, very quickly. And what does that lead to? Well, that leads to, once again, hitting 100% loss faster than you could manage it because of a sudden movement in the first morning hours, pre-market or after market as well. You've got to be a good range out of the money. You've got to use that probability between. You've got to look for 80%, in my opinion, or higher, and even an 80% above the short put strike and below the short call strike. This is a neutral position. We can tweak technicals as well, sort of try to force the Bollinger Bands to be a smaller range, looking for a channeling stock. That'd be under the technicals, where the percent BB20, if I'm looking for a stock breaking above its upper Bollinger Band, I'd be looking for 100%, and if it's below, I'd be looking for 0. But also the bandwidth. How wide are the Bollinger Bands? And if I want to look for something that's consolidating of lower volatility, I might be looking for a percent bandwidth of less than maybe 25 or less than 20. This might drastically reduce our numbers here. We had 12. Oh no, kept them the same. So we're all still good. The Bollinger Band range, we don't have anything that suddenly spiked wide or had a sudden move one direction or the other and might recover in that opposite direction. Okay, can't promise you anything, but let's test this out. It's just a theory, and this is what I've seen that works for other vertical spreads. I'm going to save this right now as an answer to Joe on July 19th. Okay. Now, I'm going to take a quick step away from power options in a sense. We're going to look up SPY. I'm just going to go to the quotes page. And, okay, excuse me. I want to take a look at the stock chart, and I'm going to go to big charts. Okay, so we see, it's hitting that high. It was above 300, pulled back. We pulled back at the end of the day today, and the VIX actually jumped up. There's a little MACD crossover there. That's a little concerning for a movement downwards, maybe a slow one. But this is just standard 3 months. It's been in a range. It's going to be hard to see, but I'm going to go back 3 years. I'm going to go back to 2016. The reason why I'm showing this very quickly is that I mentioned earlier I haven't personally traded or legged into an Iron Condor in the past 3 years. Why? Because for most of 2017, the market was, oh shoot, let's put that back in the right place, shall we? For most of 2017, the market was directly up. It was really difficult to try to do an Iron Condor where both sides were equidistant from the current stock price. I don't want to skew it one direction or the other. Was getting a good net credit when the bear call side didn't keep getting triggered for a movement or an adjustment, having to roll it. It was better just to be in bull put spreads. Sure, there were some stocks you could find that had a bearish trend and the bear call spread would look good, but it wasn't a good time to be doing that. 2018 started. Many of you who've seen some of my webinars at the beginning of 2019 here, we talked about how 2018, let's just change this back to our 2-year charts to make it a little bit more clear. But 2018 gave us structures where 6 out of the 12 months had negative market performance. You can forget February 5th through 9th, March 21st through April 5th, another jump here in June, and then we had another bullish move where now the bear call sides would have been hit on the Iron Condor, and then October, November, and all of December, and then starting off again. You might have had to skew Iron Condors in this situation to the bullish side. So you're further out of the money here on your bear call and getting less credit because the way the market was reacting. And then down here, your bull puts might have gotten hurt. And here, you're right, in the last 2 months looks pretty good. This time frame could have been pretty good to do Iron Condors. Maybe around this time frame might have been okay. This was not to the bullish, this was not to the bearish, this was not to the bullish, this was not to the bearish. This might have been okay. This is starting to hurt on the bearish side. You have been rolling those. Obviously, this hurts on the bullish side. And then this would have been hurt on the bullish side. I'm sorry, this would have hurt on the bearish side through December. And then that would have hurt on the bullish side. Okay, so I just wanted to show that as to my explanations why I haven't opened or legged into any Iron Condors in the past 3 years, because I just don't think the market conditions were correct without assuming definite management on one side or the other. I'd probably be managing close to 60 to 70% of the Iron Condors if I was using that as a portion of my portfolio over the last 3 years because of the market conditions. Assuming that I didn't set up a plan to skew it where the stock price was further away from the call side to have a higher probability because I was in a bullish market, or traded closer to the bullish side to kind of counter that net credit. I like to see equidistant and just a standard position. But again, not much we can do here. Oh yeah, let me take a look at this. Let's go back 3 months. It's probably not a big enough movement over the last 3 months to do this, but we're going to take a look. All right. Let's try it. On a trial, I have about 2 or 3 months of access to the historical data. I know I'm cherry picking and I apologize for that. But let's take a look at what the Iron Condors would have done on June 1st going forward 14 days. Okay, now all of July might have been pretty good for Iron Condors, especially in the broad-based indexes, as long as you were careful and you didn't go too close to the money for that higher return, right? Looking for that 25–30% return, you would have been less out of the money. So I'm going to go into backtest. We're going to go into smart history. And we're going to run our Iron Condors on the first day of June. Not even sure if it was the first. It was the 3rd, was the first trading day. And we're going to open the weekly Iron Condors. Okay, remember we saw the pattern of just the broad-based market, that it moved up kind of significantly from about June 3rd to about middle of June, or in the first 5 or 6 days. Now, I apologize that the backtest might take a little bit longer than normal to run the screen. The reason why is right now in the background we're updating all of our historical data. Okay, so these look pretty good. For June 7th expiration, Monday, June 3rd, that weekly Iron Condor, 4 days out in time, good probability, 75, some at 84, some at 80, some at 87, fantastic. Okay, now let's calculate group results. This might take a while. So what I'm looking at here is of those top 15 that matched on just the default weekly Iron Condor search, when we saw the market moving to the upside, what this is going to show me is how many of those trades, well, how those trades ended in those 4 days. How many of them were profitable? What was the profit? Oh boy. Twilio, when we opened the position, the short put was the 117 and the short call was the 133. Stock in 4 days ended at 144, so at expiration, look at these losses to the bullish side. 104 days, 100% loss, 100% loss. Did have a 21.4% return and a 22.7%. Again, I am cherry picking. But take a look. So 2 out of 15 worked in those first 4 days with that bullish move upwards. Average return was a loss of 78%. We can't take that, and we know it. Even if I put 15, only allocated 15% of my portfolio to Iron Condors, I'm down 78% of that monetary amount, so down probably 13% of my portfolio. That's a hard thing to swallow. QQQ and SPX moved up 6 and 4.5%. And okay, so maybe I'm cherry picking. But what I wanted to show you is, what if I did that same thing on June 3rd and answer to Joe on July 19th? So we Twilio, Okada, Wayfair, Roku. I'm just looking at some of the names here. We're going to run that other search with the higher probability, little bit lower return, but going 14 days out instead of 7. Or in this case, 4. My apologies, I need a drink of water there. All right. Biogen, Workday, CVS, Facebook, Align, MasterCard. Oh, no. Oh, no, I did. Good. I wanted to make sure that we were not using any stocks that had earnings between now and expiration. All right, so we were only correct on 2 out of 15, minus 78% with the weekly Condors that were 4 days out in time. It's not to say that the criteria that we have as default is bad. It's just showing an illustration of why I might not have used Iron Condors in these kind of cycles that we're seeing. But we're going to take a look at this one that I suggested might work better. And I'm not promising it is. It might do worse because it was further out of time. It was 14 days out of time, so that bear call side might have been threatened more. So the adjusted 2 weeks out, I apologize. It's churning and burning. There we go. Still some 100% losses, which, by the way, yes. In most cases, we would have avoided 100% losses. Joe, with just the weekly search, I'm sure you would have closed them out once the short call would have been threatened, or the short put. In these cases, it looks like all of them were on the short call side, all of that bullish move upwards. So I took 1, 2, 3, 4, 5 full losses and 2 minor losses. 8 out of 15, but only a loss of 22.9%. All right, so that's 8 out of 15, 6% more 6 trades more profitable, but only a loss of 22.9%. Still terrible, but to which direction? To the bullish side with the bear calls. Now, I'm saying that I prefer, and by the way, in most cases, I'm only opening the top 2 or 3. So whenever I do anything, Joe, iron condors, bull put, credit spreads, I'm likely only allocating 10 to 15% of my total portfolio because there is the chance that you could lose 100% in an instant due to an unexpected market move. February 5th through 9th of 2018, 3 bull puts open following the bull put weekly positions that I use, also talked about in the product I mentioned. And within that first move on February 5th, one position was down 20%, whereas at a small profit the day before. They all expired February 9th. And they were opened on June 23rd, I think, 22nd. I'm sorry, January 22nd, my apologies, of 2018 for February 9th expiration. But one trade on Netflix was bull put was at a 20% loss, and then the 2 others were at a 60 and 66% loss. And then in the next day, I closed that one of those at a 65% loss. The next day, it would have been an 80% loss. Netflix actually went back up to a small profit of 8% before going to a 100% loss 2 days later. So that was very interesting, but they happened so fast. So you can continue this thought process seeing what happened. Even in that very bullish market on both sides, we increased the win ratio from 2 out of 15 to 8 out of 15. It's above a 53% win rate, still not great, but we dropped the loss from 78% down to 22. And again, I'm cherry picking, right? So let's say that we went just to what looks like maybe the 8th or the 10th. We'll do it one more time. Okay, so let's go back to the testing. And see here, mine would have expired on June 14th. So I'll use June 14th for this one. I'm sorry, the 17th, Monday following June expiration. And this is with our adjusted criteria looking for the higher probability. So in the second time period that wasn't as bullish on June 14th, going forward, mine will probably end on the 28th. Okay, hold on 1 second. There we go. It's Biogen again, it was semiconductors. That's going to be a tough one, I can already tell. Chipotle might be tough as well, but let's see where are we now. 82, 80%, 20, 22, and 17% profits. I'm not looking for the 30% with the lower probability, okay? Now this is going to calculate our group results once more. Five o'clock is usually the toughest time. I am going to try to do this once more. We might skip conversations while I'm waiting for when we run the weekly series next for June 14th, and I see what results come out with the higher return for the 5-day out trade, or similar return for the 4 or 5-day out trade. 5 o'clock is usually when the historical tools are updating all of the closed data from today. So all of the tables that are accessed and needed for calculations for historical testing just get bogged down a little bit. Okay. In fact, I don't know if I can do that while this is running, but oh, there we go. Look at that. That's a good time period, isn't it? 14 out of 15 profitable, and the average return was 9.4%. Why? Because the one loss was 100. But if you had kept this to 50, this might have jumped up to 16 or 17%. 93% success rate on a better time period, which is just 11 days after our first run in that bullish movement. The extra 11 days after, June 14th forward, were a good time to do Iron Condors. You can see that. But even if you think something is not that bullish, that doesn't look like a good, bullish, strong move, when it happens, and this is what I've seen in other years as well, it just hasn't seemed consistently a conducive market for Iron Condors. Okay, one last one, and then we're going to get to the next question that came in regarding some kind of technical view on a particular stock and see what strategy might be good for it next. So we're going to keep June 17th is our search date. June 14th was expiration. We would have opened it the Monday following. And we're going to go to the weekly Iron Condors again. Okay, and let's go ahead and submit that. We know we're going to have about 8 to 10 seconds here to kind of see, maybe a little bit longer, to see which trades would have matched this criteria. All right, fantastic. Beyond Meat, Tilray, Lyft, Silver is always a good one. Well, it's been bouncing around, but for 4 days should be pretty good. Let's take a look. Look at the returns, 37, 33, 34, probability only at 75. Sounds insignificant, but again, there's a follow-up question that came in from Ray. I'm going to take Ray before Shrikant's question related to Netflix, which I just mentioned. Ray's is sort of related to this, and I'm going to take that. It's related to the vertical spreads, and then we're going to talk about Shrikant's question that he's been waiting on as we wait for the historicals. So remember, the adjusted ones we sort of looked at there for Joe. We had a 93% success rate from June 14th forward, with a return of 9.4% for 14-day out trades. This one looks pretty good. We've got 2 losses, but see how quickly, oh, there's 3 losses. One was only 11%, but taking the average return, if you factored in those, being right only 80% of the time did get you a profit, but at only 3.3%, even though we are in that same bullish time frame. You had higher potential returns and higher wins. But what did I say? Remember, it went through both strike prices so quickly, 326.85. There's your 100% loss. 50.45 went above 46 and 45. And a dollar strike difference, which I probably should have filtered out as well. This isn't bad, but you see that even with an 80% success rate on these smaller net credits, even though it offers a 30, 33% return on a 1, 1.5, 2, and a 5-point spread, that 100% loss wipes out more of the gains. Even though you're right 80% of the time, you're walking out with only a 3.3% return, a factor of 10, less than what the probably average return was. Okay, now so the average return is probably 25. Okay, so that's my discussion there. I don't use the 4-day out cycle because every testing I've done on vertical spreads has shown me that trying to trade during that week for the 4 or 5-day trade does not perform as well long term. It's better to go further out of the money with the vertical spreads and extend it out 1 week so you keep that 8-to-1, 7-to-1 risk-reward ratio instead of going up to almost a 20-to-1 risk-reward ratio because of the lower net credit because you're closer in time. Is the highest return, the maximized profit, searching for the maximized return always the best idea? No. And we've seen that here, even being right 80% of the time, looking for the higher returns with the lower probabilities, even only taking 2 or 3 losses drastically reduces. We didn't take a loss. But what did we see? And it's funny because, to tell you the truth, what did I just do? I actually disproved in a very short window, in a very specific example, that our default weekly Iron Condor search that's looking 4 days out would not have performed as well as using the adjusted criteria we just mentioned to Joe. I'm probably going to change that next week, to tell you the truth. On Monday, I'm probably going to change those criteria to match what we saw. Because in that first cycle, we lost 78% on the 15 results that came up for a weekly Iron Condor default. We only would have lost 23%. And with the adjusted net credit, we would have had a 9.4% gain in that cycle we just saw, versus only a 3.3% gain of being right 80% of the time. That second one is outperforming it. But again, I've got to test many more months of that, and I'll take care of that for you guys and let you know what I do. But that's my thought. It's not about maximizing the return, even in credit spreads or more. It is about getting the right, this is the default one, getting the right probability to what should be a successful range with these vertical spreads, still looking for a good return, not expecting 30, 25, 40% yield on even a 14 or 30-day Iron Condor because the probability is too low. Get yourself to that profit range where you're targeting sort of 82, 83% success rate, and even though the return's lower, I have a very strong confidence you're going to be successful more longer term than forcing a higher return position with only a 70, 75% probability. Okay? So Joe, I hope that answers your question. It's not just about maximizing profit, it's about being successful long term. And again, I illustrated why I haven't been trading or even legging into Iron Condors long term. I'm going to address this briefly for Ray, and then we're going to get to Shrikant's question. I'm going to add bull put credit spreads back in, and I'm not going to go too in-depth into this, but I just want to have this discussion here. All right, let's go to bull put credit, and let's go to search. I didn't want to go to search. I wanted to go to bull put home. This is just the one side of the Iron Condor, okay? And what Ray's question is as we all know, what we want to have happen on just the bull put side, I sell a put here that's out of the money, 85% probability for me personally or higher, and I'm buying a lower strike put. Now, I want the stock to stay, the stock price is probably here when I enter the trade. I want the stock to stay the same or move up. It can even fall a little bit, and I'm still making a profit. Doesn't always happen. As I mentioned, February 5th through 9th, 2018, stocks fell and were between my strike prices here. Two of them were at one was at a 66% loss. One was at, I think it was 65 or 64.5. We'll just call it a 65% loss. And my Netflix trade was at a 20% loss. Those were the three bull puts I had open on February 5th. Now, let's say that just in general, I look for sort of the same return we were. I was looking for 11 or 12% return on those spreads that I was in with the 85% probability. What does that mean? Well, it means about a 20-cent net credit for a 2-point difference in strike prices 2 weeks out in time. Right? That's your 11%. There's really a true risk of 20 cents profit to 180 risk comes out to be about 11.1%, 12%. Now, why this is kind of important is that if I want to keep in that downturn on February 5th, these two here, the stock was a little bit closer to the long, but not quite there, but it was between the strike prices. The market is collapsing down. Ray's question is simply, in an unprofitable bull put spread, is it possible to roll out, or you just keep digging yourself deeper and deeper in the hole? My experience is that if the market turns, you're digging yourself deeper and deeper the hole. Why? Because here, if I don't remember the prices, but let's say this was 100 short put, and this was my 95, no, I'll call it a 98 long, and the stocks were trading at 110, and then on February 5th, they dropped down to 99, okay? I closed this out. Now, what this 66% means is 2/3 of the full loss I could have taken on the position. So I'm pretty much paying $1.20, $1.40 to close this out, and I only took in 20 cents. So I've got a debit now of $1.40. I could look at, and this is February 5th, remember, 2/5, right? Now, I could have looked out the next 2 week cycle. I could have looked out to March, for example, March expiration, and rolled down on one of these two with a 65, 66% loss, okay? And I could have gone further out of the money. Now, if I look for my same 85% probability that I want, that I look for, Ray, with the same range out of the money, going out to an expiration, say, I think it was 3/17. It was right around St. Patrick's Day, wasn't it? Or the day after, day before. Oh, sorry. Even going a month and 12 days out, what would I have not gotten with an 85% probability? I would not have gotten $1.40 net credit. By the way, that $1.40 includes the 20 cents we already took in. It was about $1.60 to close it, so I'm losing $1.40 on that bull put spread. That's not going to give me $1.40. That might give me nearly twice, maybe 35 or 40 cents, not 7 times. I'd probably have to roll out at this point to where we are now, July, August, or September. And I'd also have to typically increase the strike prices as well as going farther out in time. Because, hey, no bull put credit spread that's 2 strikes apart is going to give me $1.40 net credit unless it's already in the money. That's the tricky part. So now I have to ask myself, is it worth it to roll a bull put spread out 7 months, take 2 to 3 times to maybe even 4 times the risk of the difference in strike prices to get this $1.40 back just to break even, rolling from February 5th out to, okay, 6 months, out to August, or out to September, 7 months away? I don't think that's worth it. I think it's better, and this is what I did. I closed these two. When they get to a certain point, I usually try to target about 50%. When they get to that point, I closed those positions. Yes, I took the $1.40 loss, but continuing with the same trend, if it's the right time to trade them, which is discussed in that bull put credit spread product, then I'm going to make this back faster, keeping the trading plan in place. I meant this back up. Actually, I didn't even lose this. I'm going to explain why in a minute. But I'm going to make that back up faster, probably by April, just allowing the 66% loss 20, and then over the next 2 weeks, keep trading the bull put spreads that have been continually showing an 86, 87% success rate, and not worry about that loss. I haven't hit 100% loss yet. Pretty lucky on that, but I have had to close ones before. So, Ray, there is still a webinar available. I can tell you it's going to be taken down soon. It's one of my older ones. You go to powerop.com/webinars.asp. That's actually a public page, but some of the webinars are turned off for non-subscribers and non-trial members. But go to Option Strategies. Let's see, it says subscriber access here, but that's okay. Older one, 8 ways to manage a bull put spread. I know you've already watched it, Ray, but I've talked about, I'm pretty sure you've seen this before, if you've heard me talk about it before, the 8 ways to manage it. But just access that, powerop.com webinars, click on Option Strategies and 8 ways to manage a bull put spread. Now, let's just go back very quickly so I can get to Shrikant's question. A review of the 7 to 8 ways to manage a bull put. So the stock's going against us. In general, I'm going to look to move it here. I wasn't allowed to February 5th through 9th because I woke up in the morning and they were all down there. But here's what I'm faced with. Number 1, do nothing. Stock's near my trigger point, which is usually around 0.5 to 1% of the short put strike price. Be on the other side for the bear call. Number 1 is do nothing. What were the market conditions that brought it down? Take a chance. Maybe it'll come back up. It's not the best way to approach it, but we got to be honest. That's a way to approach it. Number 2, I do this first, even though it's more aggressive. If the market has turned, you feel the sentiment has gone the other way, the security you're in or the market is going deeply bearish, buy the short, leave the long open. What does this do? Pros and cons. Well, close the short, you leave the long open. You now have got a long put that's going to profit if the stock keeps falling. But you've increased your cost because of you didn't buy to close this one and sell to close this one. Actually, I'm sorry, that's number 3. I'm sorry, out of order. Number 1 is do nothing. Number 2 should have been more obvious. Close it and move on. If the market's turned, you've hit your trigger point, you're at a 20, maybe 30, maybe 40% loss of the max you expected to take, close and move on. Don't close and roll. Close and move on. Just look for a new position maybe later on that has the criteria you met that have been working for you, and just make it back using structures that you know have been right 80, 83, 85, 88% of the time. So number 1, do nothing. 2, close and move on. 3, buy to close the short, leave the long open. Now you're in kind of a very expensive long put position. You're still going to need the stock to move faster. Only consider that if you've got maybe 8 to 10 days left and you're really confident that it's going to continue down. Number 4, of course, is what you mentioned. Roll the whole spread down and out. Even at a 50% loss, so I had a maximum loss of 180, fell to 90. Even in that case, I've got to roll 2 to 3 months out and increase the strike differences to get 90 cents to get just back to break even. Now if I go 2 months out or 3 months out, right, we're 4 times to 6 times the amount of time of our trading plan. I'm using 2 weeks instead of 1 week. I'm using 2 weeks out. So if I go 2 months out, that's essentially 4 cycles, right, that I would have had. But rolling down and out and then usually involves increasing the maximum risk. So if it continues down, you have a larger risk because you had to open the strike prices to get that better net credit. Okay. Number 5, close and do the opposite. Not always the best approach because you still have a lot of the cons that you had with rolling this whole spread down, meaning that if I closed my bull put and opened a bear call, because I feel the market is going down and my bullish stock has now turned bearish from something that happened outside of general market conditions, what am I going to have to do to get that 90 cents? I'm going to have to increase the strike prices on this bear call from where I started, and I'm going to have to go further out in time. And as we saw, a lot can happen when you go 3 months out in time. That's the trickier gauge in this market too. In a market driven by news and Twitter comments and things of that nature, of course, the Iranian incidents, global concerns are a lot, but it seems like now headline news affects the market just as much as anything else, and that's kind of dangerous. Some of these neutral positions, such as iron butterflies and iron condors, are risky. But doing the bear call is the same problems with number 4. 6, you could convert it to an iron condor, but that's more along the lines of saying that, hey, I don't think this trend is going to last. I think it's going to recover back up, but just in case, I'm going to get a little more premium and leg into an iron condor for an extra credit. You can still lose in 2 ways at that point. Kind of difficult. Number 7 and number 8, well, they're discussed in that webinar, but they're going to be handled in depth in the real product there, so I'm going to save that for later. My favorite thing to do is the stock between the strike prices is the pendulum adjustment. It is talked about in that webinar, but the full discussion is going to be available in a more complete product later on. So check out that webinar, Ray. Let me know your thoughts on the 8 ways to manage the bull put credit spread. Sort of reviewed them there for you. Number 4 is one. Rolling down the spread, just rolling down the spread, putting it further out in time, just like people roll a covered call. But it's not my favorite, and it's one I very rarely use. I don't even think I've used it in the past year, to tell you the truth. I've either done other things or just gotten out and moved on, and usually made it back faster than if I had rolled down and out and increased the strike prices, which also increases the margin, so it's taking away from other trades that you'd be in. Okay, so that's why I just don't roll out in most cases. 95% of the time, I think I don't just roll the puts down when a trigger's hit.